Have you ever wondered how the multifamily housing market is adapting post-pandemic? Well, today we're diving into some intriguing data that sheds light on this very topic. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to investing.com, Redfin, a technology-powered real estate brokerage, has reported a significant decline in permits for multifamily housing units in the United States over the past year. Their analysis of U.S. Census Bureau data shows that developers obtained permits for 12.4 multifamily units per 10,000 people. This represents a 27.1% decrease from the pandemic building boom and a 5.5% drop from pre-pandemic levels. During the pandemic, the surge in remote work led many Americans to relocate, which caused an increase in rental demand. Builders responded by ramping up construction, particularly in high-demand areas like the Sunbelt metros, such as Austin, Texas, and Tampa, Florida. This construction boom resulted in a record number of new apartments completed in 2024. However, as of now, with rents stabilizing and borrowing costs on the rise, the once attractive prospect of building has lost some of its luster. Redfin's senior economist Shahryar Bukhari pointed out that new apartments are being rented at the slowest pace on record. He also mentioned that elevated interest rates have made many projects too expensive, prompting builders to scale back. This slowdown could potentially lead to fewer rental options and possibly higher rents in the coming year. Interestingly, despite the overall decline, Austin, Texas remains a hotspot for developers. Over the past year, the city granted permits for 64.5 multifamily units per 10,000 people, the highest among the 78 U.S. metros analyzed by Redfin with populations of at least 750,000. Other top metros included Cape Coral, Florida, Northport, Florida, Raleigh, North Carolina, and Orlando, Florida. Conversely, Stockton, California, recorded 0 new permits in the past year, marking the lowest among the metros analyzed. Following Stockton were Bakersfield, California, El Paso, Texas, Providence, Rhode Island, and Baton Rouge, Louisiana. Since the pandemic, 63% of the analyzed metros have seen a decline in multifamily construction, with Stockton experiencing the largest drop. On a brighter note, some areas have seen an increase in permits. Oklahoma City experienced the biggest increase, with permits growing by 193% from 1.7 units per 10,000 people during the pandemic to 5.1 over the past year. However, this is still below the national average of 12.4 units. Other metros that saw substantial permit growth included Pittsburgh, Hartford, Connecticut, Baton Rouge, Louisiana, and Milwaukee. In a move aimed at tackling the affordable housing crisis in the United States, Senators Ruben Gallego and Dave McCormick have introduced a bipartisan bill known as the Housing Affordability Act. The legislation seeks to increase the supply of affordable housing by raising the Federal Housing Administration's outdated multifamily loan limits, among other reforms. Senator Gallego emphasized the importance of making building homes easier and cheaper, pointing out that outdated regulations are a significant barrier. By updating a nearly 2-decade-old loan limit, the Housing Affordability Act will expand access to affordable loans for building multifamily housing and ultimately bring down housing costs, Gallego stated. The current FHA multifamily loan limits have remained unchanged since 2003, and the dollar volume of HUD-issued multifamily firm commitments has declined significantly over the last 5 years. Under these limits, nearly all communities are categorized as high-cost areas, which has inadvertently hindered necessary multifamily housing projects. Senator McCormick underscored the pressing issue of a lack of supply as a major obstacle to affordable housing in Pennsylvania and across the nation. He believes that increasing the FHA's multifamily loan limits is a crucial step in incentivizing the construction of more apartment buildings, thereby enhancing housing access for families. The proposed legislation would amend the National Housing Act to raise the statutory loan limits. Additionally, it aims to update the Inflationary Adjustment Index from the Consumer Price Index to the Price Deflator Index of multifamily residential units under construction, which is considered a more accurate reflection of the true cost of multifamily housing construction. Notably, the Housing Affordability Act has garnered support from several organizations, including the National Association of Home Builders, the National Association of Realtors, and the National Multifamily Housing Council. These endorsements highlight the broad backing for measures that could significantly impact the multifamily housing landscape. Bill Kilmer, Senior Vice President of Legislative and Political Affairs at the Mortgage Bankers Association, praised the effort, noting that the act would make long overdue updates to FHA's multifamily insurance programs. He commended Senators Gallego and McCormick for their dedication to removing outdated regulatory barriers that delay workforce housing development. As we continue to explore the multifamily real estate market, it's essential to understand the shifts taking place in different regions. Today, we're turning our attention to the Dallas-Fort Worth area, where significant changes are underway. According to John Griggs, co-founder and co-chief executive officer of Presidium, the DFW multifamily market is at an inflection point. Griggs emphasizes that while the capital markets remain tight and new construction is slowing, DFW's fundamentals are strong, and the market is resetting. Griggs notes that DFW experienced substantial growth between 2020 and 2023, with nearly 500,000 new residents, more than any other metro in the United States. This growth has created a structural cycle where jobs follow people, leading to an 11% increase in employment since 2020. Moreover, the cost of homeownership has surged, making renting a more attractive option for many. It's now about 60% more expensive to own a home in Dallas than to rent, which keeps demand for quality rental housing strong. On the supply side, Griggs points out that construction financing is available again, but with higher rates and more equity required. Many projects that made sense 2 years ago are no longer viable, leading to a significant slowdown in new deliveries. However, this presents a unique opportunity. High-quality assets are trading at prices 30% below their 2021 peaks, offering investors a chance to acquire properties well below replacement cost. Griggs sees this as a window for disciplined investors to act before the market tightens again. Griggs also highlights a shift in strategy at Presidium. Having initially focused on acquisitions, they pivoted towards development between 2018 and 2022. Now, with the market dynamics changing again, Presidium is back on offense, seeking assets with clear downside protection and strong submarket dynamics. Griggs remains optimistic about the long-term prospects, noting that the DFW area was recently ranked the #1 market for real estate investment in 2025 by the Urban Land Institute and PwC. While the DFW market might seem distant from our focus here in Canada, there are valuable lessons to be learned. Understanding how different regions adapt to economic pressures can provide insights into the potential future of our own markets. The ability to recognize opportunities during a market reset is crucial for investors everywhere. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.